Good morning. Welcome to today's webinar, Strategic Wealth Planning in the New Tax Environment. Today's event will provide you with planning strategies for trust, taxable versus non-taxable planning, planning for assault limitations, and information about personalized solutions for optimizing new tax opportunities. There is a lot of ground to cover, but before we dive in, we want to let you know the tax and wealth planning specialists at HBK and HBKS are available to you beyond today's 1-hour webinar. We will have time today for some Q&A, but this is a big event, so if we don't answer your question today, please get in touch with us. To submit your questions during the session, use the Q&A box that's located in the lower left-hand corner of your screen. Working together to set us apart, we have presenters from HBK and HBKS, Amy, Dalen, and Paul Taylor. And now I will turn over to Amy and Paul to get us started.
Great. Thank you very much, Michelle. And so thank you for joining us today. We have a lot to cover here, talking about a lot of the planning opportunities that have come out of the One Big Beautiful Bill, or the OBBB, or OB3, whatever you want to call it. I like to start off these with a general caution. There was a House version of the bill, and there was a Senate version of the bill. And what passed was the Senate version. I am still seeing a lot of articles out there and a lot of commentary and some questions that come through to us asking about specific provisions that didn't actually make it into the Senate bill. So please use caution when you're looking at information coming out about this, and make sure that you're actually looking at information related to the Senate bill, because that's the version that actually made it into law. Now, one of the big things about this new law is permanency, and that was a big focus within the Senate. The House version did not make a lot of those provisions permanent, but when it got to the Senate determined that economic growth looked better having permanent tax laws, so that we could do a lot of planning based on those permanent tax laws that are in place, and we could craft strategies that look to the future instead of always looking for that next cliff that was going to be coming. So really, permanency was a very big part of this legislation. Now, there were a lot of temporary provisions that were put in, and a lot of these are focused on the campaign promises, and they imposed these new income thresholds that we have to be aware of. And as part of that planning, it's really looking at if you have income that are around those thresholds and you could potentially benefit from some of these new campaign promises here. Could we work it out so that you would benefit from this? So, Paul, do you want to talk a little bit about what you're seeing over on HBKS side, how you're planning for some of these income thresholds?
Yeah, absolutely. Thank you, Amy, and welcome everybody. Really, Amy, like you said in the very beginning, the permanency of these tax laws and the extension of TCJA, it's simple blocking and tackling, things that we do from a financial planning perspective with our clients all the time, in order to manage their income and or take advantage of certain strategies for them. So just running through a few of them that are common conversations that we're having around deductions, maximizing those. So with the increase that is now made permanent of the standard deduction, a lot of people in years, because they don't have enough itemized deductions, have to take the standard deduction. But those that are charitably inclined of our clients, we really look forward to, or we look to the strategy of bunching those deductions or charitable contributions into a given tax year. So for instance, we'll have a client who maybe makes a commitment to a local charity of their choice for a capital campaign or what have you over a 5-year period, making those contributions maybe in 2025, for those 5 years into maybe a donor advised fund, and then releasing those out to that charity over time can make sense in order to increase their deductions and get those itemized deductions this year, and then maybe take the standard deduction next year. So really looking at from a charitable planning perspective. The secondary one from a charitable perspective is, for our clients that are over 70 and a half, and a lot of assets for many of our clients are in qualified retirement plans, and sometimes they don't need those assets, right? So required minimum distributions start at age 73 now, and so we look at if they don't need that income and they're charitably inclined, instead of taking that income and being taxed on it, or maybe that income pushing you above certain thresholds that you mentioned, where you're not able to get those deductions or it increases your Medicare insurance premiums. Looking at using qualified charitable distributions. Once again, you have to attain the age 70 and a half in order to do this, and you can do up to $108,000 to a charity or a number of charities in a given year. Additionally, looking for accelerating or deferring certain incomes, right? So Social Security planning, when is the right time to take that? Should you delay it? So delaying those types of incomes or pensions at certain times. But a lot of our clients, when they retire, they haven't started Social Security, they don't need to take requirement distributions, and they might be in a much lower tax bracket than they were used to when they were in their working years. Looking at certain strategies like Roth conversions. So taking advantage of these lower brackets that have been extended, continue to take advantage of those in order to push some of that income and create a tax-free asset, right? Whether that's going to be for their use in the future through a Roth IRA, or it's a great legacy to leave to their heirs in the future if that's a goal of theirs, looking to maybe expedite some of that income. And then finally, Amy, just around the investment management approach at the firm, it's really looking at managing those investments in order to take advantage of these exemptions or keeping income below certain limits, right? So, capital loss and management isn't something, gain and loss management isn't something that is done just at year end. It's something here at our firm that we do throughout the year. So making sure we're managing that and working with you on the HBK side or the clients outside CPAs in order to understand their full tax picture and make sure that we are offsetting any gains with losses, or in certain circumstances, there's still a 0% capital gains tax for joint filers who are under $96,700 of income. Sometimes we take gains on purpose if we can get some of those gains or all those gains within that 0% capital gains rate, right? Lastly, from an investment perspective, not all investments are created equal. So really making sure that we're aware of the taxability of those investments, whether or not they pass off large capital gains or their income is ordinary income, and working within the confines of a client's goals and objectives and the asset allocation that we form for their goals and for their time horizon and risk tolerance, and looking at the location of those assets. So many of our clients, the majority of them, have both non-qualified or taxable accounts, joint investment account, revocable trust, et cetera, but they also have qualified accounts. So making sure we're very aware of putting those investments, which create more of a tax liability, and holding them in 401ks, IRAs, et cetera, in order to capture the tax deferral ability of those investments rather than realizing them. And then lastly, trust specifically, as we mentioned here, making sure that we are understanding and knowing what the administrative costs and splitting out the fiduciary and the investment management fees on those accounts, because those are deductions that trusts can take in order to reduce their income, Amy, right? So so many things that we're doing. It's a lot of blocking and tackling and things that we continue to do through the financial planning process. You mentioned some of those limitations, right? One of the big ones was the state and local income taxes, which many individuals have been talking about for years, particularly those that live in California and New York or high income taxed states. What type of planning can be done, or were you thinking about making sure that we stay under those limits and stretching out the use of that increased SALT deduction?
Yeah, so the SALT deduction has always been a very political hot point, right? Because when it first came about in 2017 with the Tax Cuts and Jobs Act, and they imposed this $10,000 limitation, that was really low compared to just getting whatever deduction for your state and local taxes that you would pay. And this new bill, it keeps that $10,000 limitation permanently, but it does a temporary increase to $40,000 for a few years there. But they tie it to income of $500,000. That's a modified adjusted gross income of $500,000. Now that's whether you are single, married, filing jointly, or you are a trust. So that means that when we're looking at the SALT limitation and planning for that, we're looking at how we can divide income across many different taxpayers. And a lot of our clients over the years have created various trusts. Some of them are considered grantor trusts, meaning that the tax is paid by the person that created the trust. And some of them are considered non-grantor trusts, meaning that the trust itself has to pay its own tax or pass that tax out to the beneficiaries when the beneficiaries receive distributions. So looking at the structure that our clients currently have, making sure that we know where the income is going to hit, and then paying attention to that $500,000 threshold is really big here. Looking at the income producing assets and where they're sitting, I think that's a necessary point in looking at, is there any asset potentially that we can move somewhere that's really high income producing that will free up the benefit of that deduction across different taxpayers. So looking at adult children, I say adult children because there is a kiddie tax. So children that are still dependents of their parents, or even up to age 26 when they're still in college and they're a qualified student, they are going to be taxed at the parents' tax brackets. So we want to be a little bit careful about that kiddie tax there. But if you have adult children that are paying their own taxes, maybe it makes sense to accelerate some of the gifting if possible, to move some of those income producing assets to the children who might be in a much lower tax bracket, and they could potentially get the benefit of that additional $40,000. So you're spreading it across family members there. Non-grantor trust, again, that $500,000 cap applies for non-grantor trusts. So if there are non-grantor trusts, or if there are grantor trusts that it makes sense to convert them to non-grantor trusts, maybe we can spread income out over those trusts and really get the benefit of that additional $40,000 for that temporary period. Now, looking at those structures, that's a really big thing, because when you put the trust structures in place, hopefully it wasn't completely focused on tax planning when you're doing it. A lot of that is focusing on the intention of where you want your assets to be, how you want them to be protected. So income tax and the taxation planning of it is just one aspect. So we really need to look at the different trust structures that are in place to see if we can move some of those assets around and really get the benefit of these higher deductions. Again, looking at grantor versus non-grantor trust, when you're dealing with the estate tax, that's a 40% tax to the extent that you have a taxable estate. And the grantor trust is a really, really good feature, because the grantor can pay that income tax, let those assets grow income tax free, and they're reducing their own gross estate by the payment of the tax. But if you're dealing with a non-taxable estate, maybe that becomes more of a burden to have the grantor paying the tax. And maybe that's going to push that grantor out of the income level, and they're not going to get the benefit of those increased deductions. So looking at whether it makes sense to actually get rid of the grantor trust status and change it to a non-grantor status is going to be a big part of this too. And then I have in here the charitable lead trust, the charitable remainder trust. These are both known strategies for getting income out or moving it across multiple years. So the charitable lead trust is where you would transfer an income producing asset to a trust, this charitable lead trust, and you would give an annuity or a unit trust payment to a charity over a period of time, so that you get a full charitable deduction for the income that goes to the charity, instead of a limited charitable deduction at the individual level. Individuals are limited to 60%, 50%, 30%, 20% of their adjusted gross income. So moving it to a charitable lead trust that gets that full deduction could be very beneficial. The flip of that, the charitable remainder trust, is really spreading income out over time. So if you're going to have a large gain event, then transferring that asset into the charitable remainder trust before that happens, and then spreading the gain out over a number of years, could also help to limit some of the income over that period of time, and potentially ensure that the taxpayer can get the greater deductions and keep their income below those levels. So some of this planning, we're looking across all these different trusts, and everybody's been putting in place a lot of plans related to just planning for the future and planning what's going to happen with the estate tax, right? And that's been a really big focus. And if you remember back in 2012, we did that planning then too, because there was this concern that the exemption was going to drop down to $1 million. And everybody was creating these new trusts, and then everybody was transferring large amounts into trusts. So we had that again this past year. And now that we have the permanent $15 million exemption for estate planning. Paul, what were you seeing when some of this was happening back in 2012? Were clients coming to you and saying, oops, I made a mistake?
Yeah, absolutely. Sometimes, one of the biggest things like you and I talk about when planning with our clients about this is making sure we're not giving away any assets that we might need in the future. So that planning happened a little bit, where people might have made large gifts that maybe they shouldn't have. And so we had to unwind things, right? When the exemption amount didn't go to $1 million, it was kept at $5 million plus inflation, 2012. And then later changed to 10 million, right? But so there were times where we had to unwind certain trusts because they didn't fit the needs of the family anymore, and the planning and those assets might have been needed for them and their living, et cetera. Additionally, at times, when we do this planning, Amy, right, we want to give away assets irrevocably that we think have the highest potential for gain, because every dollar of gain is not taxed because it's outside of their estate. But when we did this planning for some individuals, because the exemption went up, some of them needed those assets back. So we substituted. Maybe there's some unproductive assets in their estate that we could substitute for those productive assets, right? Because they weren't worried anymore about being in a taxable estate because the exemption was kept at 5 million plus inflation. So we brought those assets back into their estate so they could live on them and utilize them and replace those in the trust with, non-productive, unproductive assets. So I think it really speaks to, what we talk about a lot of times, which is, meeting the goals and of what the family needs and what our clients need, but building as much flexibility around that as possible. So Amy, what are some of the things that we continue to talk about or that we should be thinking about from a flexibility perspective when designing our clients and for clients to build their estate plans?
Sure. So flexibility is really important because, as we all know, markets go up, markets go down, tax laws change. There are always changing circumstances. Maybe you have children that have grandchildren, and now all of a sudden your focus or your intentions are going to change. Maybe there's a divorce, maybe there's a death in the family that you weren't expecting. And so having the ability to build in flexibility within an estate plan is really, really important. And there are a lot of different powers that you can build into a trust that help to provide that flexibility. One of those powers is decanting, right? If you have old irrevocable trusts, there are some states that have decanting laws that allow you to essentially create a brand new trust with all the different flexible terms that you might need and transfer the assets from the old trust to the new trust. Now, there are some caveats, and there's obviously some rules that you have to focus on when you're doing decanting. So talking with your estate planning attorney about whether it makes sense is a big part of that. But I have seen a lot of estate plans that have benefited from looking at old trusts and decanting them into newer trusts that have some of the more flexible terms and some of the more flexible distribution provisions that allow the family to really get the benefit of those trusts again. And it really kind of gives a renewed focus on estate planning and really meets the needs of the client. Something else I've seen in trust recently a lot are trust protectors. Having a trust protector in a trust is really, really beneficial because that trust protector can come in and make some minute changes if they need to. They have powers, they can be given powers that the creator of the trust cannot hold. And we're always very, very cautious about looking at the powers within a trust, what the creator, the grantor can do, because we're always very cautious about bringing that trust back into the gross estate. When you're doing planning with irrevocable trust, the whole key is to get those assets out of the grantor's estate. So if you give the grantor too many powers, then that's going to bring it back into their gross estate and completely negate all of the planning that you've done. But if you have a trust protector that's a third party, that's not somebody that the grantor can control, they can go in and they can do certain things to fix things or change some of the beneficial terms in there that the grantor could not necessarily do. And also powers that you might not want to give the trustee. I've seen instances where you have old trusts that have trustee powers that are just incredibly, incredibly broad. And the trustee essentially controls everything to the point where they can do whatever they want without the beneficiaries having any rights to really question that. And that's a really bad situation to get into. You always want to have these checks and balances within a trust to make sure that the beneficial terms are met, that the beneficiaries are going to be benefiting from those assets, but that you also give the trustee sufficient powers to be able to withhold distributions if they need to, or protect those assets to the extent they need to. So adding in the trust protector that is separate from a trustee can really give that flexibility. We mentioned spousal lifetime access trust, Paul. I'm going to have you talk about that in a second, but I want to move on to that discretionary power to reimburse grantor for income taxes, because that's actually a pretty big thing there, and something that we've seen really helpful for some of the grantors with grantor trusts. Now, there's been some litigation around this, some court case that just came out with the IRS, that adding in this ability after the fact, so once you create a trust and you don't have this discretionary power in the trust, if it's added in after, then there's potential gift tax ramifications and valuation issues and everything. So we would want to take a look at the irrevocable trusts that are created to begin with to see if that power is in there. But if there is if you are creating a new trust, adding in the discretionary power to reimburse the grantor seems to be a really good power to include. And if you're in Florida, they've actually put this into the statutes to allow that to happen. Now, what this does is it gives the ability of the grantor to get reimbursed and have additional cash flow there. So if they finally discover that, oh, they're paying a lot in income taxes here and they really need to have additional cash or additional assets, then they can get reimbursed for that. And that can really be helpful from a cash flow perspective. And then finally, the use of distribution committees in trusts. I like this as a way of creating non-grantor trusts as opposed to grantor trusts. And certainly when we were talking about that state and local tax deduction and the additional deductions that are so focused on the income thresholds, if you want to create a non-grantor trust, but that the spouse or the grantor is still a beneficiary of, one of those ways is to do a distribution committee in there with an adverse party. So some of the little planning tools that we have available here, we just have to work within the confines of the income tax rules and the estate tax rules when we're drafting this. But circling back to the spousal lifetime access trust, these were really, really popular. I've seen this over the past 10 years at least, that a lot of these have been created. And Paul, can you talk a little bit about the slats and what you're seeing with these created?
Yeah, absolutely. With these higher exemption amounts, people want to take advantage of it. But once again, when doing these gifts and using these exemptions up from an estate planning perspective, we have to give away assets. And sometimes, as we mentioned, these individuals, a married couple, for instance, you might want to reserve the right to have access to that, or one of them to have access to it in the future. So a very popular strategy that we've been implementing for years, right, has been the spousal lifetime access trust, where one spouse creates a trust for the other irrevocably in order to use up that the grantor spouse's exemption amount and shelter future growth from their estate, right? So they've been extremely popular. Given that we aren't going to go back to lower exemption amounts, et cetera. I mean, there's going to be certainly instances where we're looking at the flexibility of the trusts as we just mentioned, and reviewing them and making sure that they still meet their needs, or if we need to make any changes, and hopefully there's the flexibility to do that in a lot of these trusts. And certainly that flexibility is something that we run across a lot, right? When we review old estate plans and we're looking to make updates, and it's a huge focus of ours. Along those lines, Amy, with a $15 million exemption per person, $30 million per couple, there's certainly going to be a lot of people under that amount. There's certainly going to be people above that. I mean, what are some of the differences in the approach that we're taking with those individuals that are maybe non-taxable estate tax estates versus those that are above the threshold?
Yeah, so it really does change the planning a bit. It changes the focus because we've got this $15 million exemption. Now that $15 million exemption comes into play in 2026. For 2025, we still have 13.99 million. And with that 15 million, we've got that increase of about, a million or so that frees up some gifting, right? Now, after 2026, that 15 million is going to increase with inflation each year. So we're looking at in 10 years, we could have a $20 million exemption per person. That means that there's a lot of people in the country that are just never, ever going to be paying estate taxes. And when you look at that, you say, well, do we really need to plan for this potential 40% estate tax? You really don't. And the focus really shifts to income tax planning. It really focuses on what is happening on the income tax side. How can we use our structures in order to benefit from an income tax standpoint? But then also keeping in mind some of the other reasons why you would create trust and why you would engage in estate planning. I think everybody needs to have an estate plan. And whether you actually have a written estate plan or not, you actually have an estate plan, because if you don't have a will, you don't have a trust, then everything is going to go by law. And that might not be how you want everything to flow. So using trust can help to ensure that your assets are actually transferred the way that you want them to. And certainly revocable trusts, they are beneficial because the successor trustee can just step right in and take over and manage those assets once you pass away, which can be really beneficial, that you don't have to worry about going through the whole probate process before they can actually get a hold of those accounts. So expenses can continue to get paid, distributions can get made, your heirs can get taken care of. And so trusts really have their place in an estate plan, even if you don't have a taxable estate. But I think when we're looking at taxpayers that have less than 15 million or less than 30 million in estates, and they're probably not going to have a taxable estate in the future, if ever, it's really looking at the strategies that they've implemented in the past few years, because this group of individuals, they've probably been looking at the potential decrease over time and saying, well, I need to implement this, I need to do something here, and this is going to benefit me in the long run here. And even if the tax laws change, this will still work. But really looking at what has been put in place over the years is really important. I know over the past few years, we've looked at irrevocable life insurance trusts that hold life insurance in them, and the death benefit is just not very high. And from an administrative standpoint, doesn't make sense to continue to have that trust if you're never going to have an estate tax that you have to worry about. So really looking at the different strategies that our clients have put in place, I think that's really, really important. I mentioned the income tax planning, really looking at where that income tax is hitting. That is going to be important. What are those assets that are held within the trust? A lot of times when we created irrevocable trust, sometimes you transferred real estate into the irrevocable trust, and now the grantor is paying rent in order to use that property. Maybe it makes sense to go ahead and exchange and get rid of the ability, the need to continue to pay that rent. And now you have other assets in that trust that can benefit your heirs. So really looking at some of these different planning opportunities, I think, is really important. Low basis assets. This is big, because if you're never going to have an estate tax, you really want to die holding low basis assets. I hate talking about dying, right? But that's such a big part of estate planning and what we have to focus on. And that's really it's a hard conversation to have. It's like you're trying to position yourself to be in the best circumstances possible to get the best tax benefits when you die. But that's really what looking at low basis assets is you want to hold those low basis assets when you die, because they get a basis step up to the fair market value as of your date of death. And that can be really powerful for a surviving spouse if they have to sell the asset in order to continue to maintain their lifestyle. Maybe it's a really, really large house and they don't need that house anymore. And the kids are all grown and they're out and they just want to move to a smaller condo. Or maybe they're moving in with one of their adult children because they need to be taken care of on a regular basis, and that child is going to help. So the low basis assets and that basis step up, that's going to be really big. Power of substitution and grantor trust. This is a really, really powerful power. that doesn't get utilized as much as I think it should. And I think that's really an analysis that needs to happen on an annual basis, looking at what are the assets in a grantor trust, what are the assets that that individual still holds, and does it make sense to do a substitution back and forth to get the low basis out, or even accelerate some losses that are in the grantor trust. What makes sense there? Really analyzing that. Transferring assets back and forth can really be powerful. There's no income tax result there. You're not going to recognize gain because it's as if you're transferring assets to yourself. So I really like looking at that power and how that could really help. Analyzing the life insurance policies I mentioned before, irrevocable life insurance trusts. Sometimes these were created back in the 90s, back when the exemption was 600,000. And now it's just, does it make sense to really have this? Sometimes those life insurance policies have actually lapsed. We've had instances where the trust document can't be found. There's a policy somewhere, they keep on getting a statement. It's paying for itself, but is it really doing what it should be doing? And so analyzing that is really important, and looking at the trust and what was it established to do. Can you decant it into a new trust that can have different provisions? Can you exchange that life insurance policy for something else like an annuity, or just cash it out and then start investing those assets? Sometimes a lot of that discussion really needs to be had, and we have a lot of old trusts that just really need to be looked at from a planning perspective. Now, shifting gears here, though, if you do have a taxable estate still, you have assets over that 15 million or 30 million, or you've already used up all of your gift tax exemption and you still have a ton of assets and you don't know what to do. Good news is that you've got that additional 1 million or 2 million if you're married freed up. So that opens up opportunities for additional gifting in 2026. Now, when we're looking at additional gifting, we're looking at what is going to give you the greatest benefit for what it is that you are trying to gift. And a lot of times that means you're looking at ways of using discounts. Discounted values are really, really powerful. And we saw this a lot, especially leading up to 2026 when we thought the exemption was going down. We saw a lot of family LLCs or family LPs, limited partnerships, created with investable securities in that, or maybe it had an operating business in there, or maybe it just had some assets in there that they wanted to manage within an LLC. And so gifting interests of the LLC at a discounted rate, or interests of a partnership at a discounted rate, means that you're going to get a lot more value out of your estate at a lesser amount of the exemption, right? So if you get a 30% discount on the value, then you are benefiting already from that 30%. And we have seen this strategy really work when we have taxpayers that have operating businesses they're planning to sell within the next few years. And they're saying, I think that the value right now is low, but it is going to increase in value in the next 5 years, and then I'm going to sell it at a major profit. And what we have seen is introducing these irrevocable trusts that then receive a portion of the value of that business at a discounted rate. When it eventually sells, that trust now gets a portion of the proceeds, but that percentage of the proceeds that was transferred in. And that can be a really, really big tax savings. That is a lot of power there. So really looking at that discounted gifting opportunity, that I think is a really big thing to do. Annual exclusion gifting, I see this a lot. It can be really powerful over time, right? Every year you can gift up to $19,000 per person to each donee. That means that a married couple can each give $19,000 to their son or to their daughter, or to their son-in-law or to their daughter-in-law or to their grandchildren even. And when you add up the number of people that you want to gift to, it can be a large number. And if you do that annually over time, you can really get a lot of assets out. Now, there are strategies that you can do annual gifting through trusts. So if a trust has what we call a crummy withdrawal power, that was named after a court case, crummy was the name of the court case there. If you have a crummy withdrawal power there, that makes it a present interest that you can then treat that as an annual exclusion gift to the beneficiaries of that trust. So if you don't want to give it outright to your children or to your grandchildren, maybe you want to create a trust that has that withdrawal power in it so that they can then benefit from it in the trust. It's protected within the trust, but you still use your annual exclusion. You're not eating into your exemption, especially if you don't have a whole lot of exemption left after all the gifting that you've done. That's really one of the big powerful ways that you have to continue gifting over time without incurring the gift tax. Freeze techniques. These are our go-to strategies when we have no more exemption remaining, but we know that the value of these assets are going to continue to increase over time. So you've got grantor retained annuity trusts, and these, especially if you do rolling grats over time, these can be really powerful. So what a grantor retained annuity trust is it's a short-term trust. I typically see it anywhere from 3 years to 7 years, maybe 10 years, that you transfer the securities into this trust, or you transfer the assets into this trust, and the grantor takes back an annuity. And that annuity is determined based on what's called the Section 7520 rate. It is a monthly rate that the IRS puts out. And as long as the assets that are transferred into that grantor retained annuity trust increase at a rate that is higher than that Section 7520 rate, at the end of the term of the trust, you're going to have this remainder value that can pass to beneficiaries without using up any estate or gift tax exemption. And it's not going to be considered income to the beneficiaries. And so it essentially just it can flow into a trust for the benefit of beneficiaries. And we have seen a lot of that additional appreciation get out of clients' gross estates through just creating these grats. And every time they receive an annuity payment out of the grat, they then create a new grat. And that's the rolling piece of it. You're just constantly creating these new trusts. So that can be really powerful. A sale to an intentionally defective grantor trust. If you have a business, this is a really big strategy because you can sell it to a intentionally defective grantor trust. So it's a grantor trust. So there's no income tax consequence there. You're not going to recognize the gain. You're going to take a note back and you're going to receive the payments on the note as the business makes distributions into the trust. But it gets the appreciation of that business out of your estate. The value that you sold it for is still in your estate through that promissory note, but the appreciation, that future growth of the business is out. So that can also be helpful as well. Certainly looking at charitable planning opportunities, that's important. And cash flow planning is important. Paul, do you want to talk a little bit about cash flow planning? Because I know that's a lot of the looking on an annual basis, your personal financial planning, that's really important.
Yeah, so we spend a lot of time, obviously, with our clients as it pertains to them, what their needs are going to be, and really putting forth, a really good plan around making sure the resources are available now for them to enjoy, but also well into the future. So whenever, putting together these more complex strategies, we do a lot of cash flow planning and our ability to model, if you make this gift or if you do this certain trust, here how it affects, your day-to-day life, but also benefits you for the future, right? And making sure that we have the right level of wealth that was retained in the estate for cash flow reasons, et cetera, along with, making sure we maximize their exemptions and their estate planning in order to provide for whatever their goals might be in their heirs for the future. So we spend, obviously with your help and from me with the other advisors of making sure we're marrying personal goals with legacy goals, cash flow, et cetera.
Yeah. One of the things that I always try to emphasize when I'm talking with clients is, yes, we can do all this gifting. Yes, we can create all these structures and create a really complex plan. But at the end of the day, you need to determine how much you need to survive to maintain your lifestyle. And then you know what excess you have that you can work with. Because nobody ever wants to gift away their retirement. Nobody ever wants to gift away the ability for them to pay for that assisted living in the future and their healthcare needs as they get older. So working with you, Paul, and HBKS to really get that number down is critical to everything that I do when I'm looking at estate planning.
Yeah, if we go back to talking about, 2012 and unwinding trusts and whatnot, if you're operating and doing this estate planning in a vacuum and not really seeing how, the choices that you're going to make or taking advantage of these are going to affect your financial future, once again, because these are mainly irrevocable choices that you're making per se, that's when we see issues, or those that don't operate through as much flexibility as they need in their planning, and we're having to unwind or undo things, redrafting, which costs more money. So really having us involved, along with yourself, and attorneys, and all working and collaborating together, we usually have the best outcome for our clients, right?
Absolutely. And that's honestly, I think that's why spousal lifetime access trusts have become so popular, because it still gives access to those assets while also using up the estate tax exemption. So it's a way of gifting without really gifting. And I think that that's been very helpful for a lot of clients, especially as they get older and they might have gifted away more than they thought that they should have. And then the ability to actually receive those distributions. Because as we all know, things change, financial situations change, and sometimes a spouse passes away and we lose access to something that we didn't realize that we were going to lose access to so soon. So planning with flexibility in mind and doing all of that, I think, is really critical. So our call to action today, as we're going through all of this, is really focus on your estate plans, right? Where do you fit in the income spectrum in your gross estate? If you're taxable, if you're not taxable, either way, you need to be reviewing your estate plan. And I would typically say at least every 5 years. I'm changing that to annually because there are just constantly changes. It is so much. And I even heard that they're talking about another tax bill come the fall. So there are just always going to be changes happening, and there's going to be children and grandchildren born, and there are going to be deaths, and you're going to be going through a lot of different life changes over the next few years. So making sure you know what your estate plan says and how it's going to flow is critical. Another really important thing, and I have seen this firsthand, make sure you know where your original documents are. Make sure you have executed documents in a safe place. It might be with the estate planning attorney that you're using, or it might be in a safe deposit box. But make sure someone knows where that is, because when you die, your heirs are going to look around and say, where does everything go? Where is everything sitting? And they're going to look for those documents. And if they can't find them, they can't carry out your intentions. So the first piece is actually putting in place your estate plan. But then the second piece is making sure that when you're gone, your estate plan can actually be carried out how you want it to be. And Paul, do you want to talk about the life insurance reviews?
Yeah, absolutely. So along the same lines, from an annual review and making sure that everything's coordinated, certainly, as you mentioned, life insurance trusts were created 90s or even earlier, right? And some of those life insurance policies inside of those trusts might not meet the needs today. Things change, financial circumstances change, and projections change on those life insurance policies, right? When they were put in place many years ago, and they're dependent upon certain interest rates, and returns. So one of the services we provide is collecting that type of information through the financial planning process and reviewing those insurance policies to make sure it's still meeting your needs. What's the purpose of it? What are your goals now versus when you put it in place? And then really checking the health of those policies against the current marketplace, and the performance of that, just like any other investment, right? There's a lot of other areas that when we go through this process, Amy, right, that we need to look at. Beneficiary reviews. People change jobs, people retire and roll over assets. Making sure that your qualified retirement plans, life insurance policies, what have you, that those beneficiary designations are coordinated with the estate plan you spent money on and so much time doing, to make sure that your wishes are carried out the way you want them to be. That's an area that we see many times that we catch, that instructions were given, or people rolled money over and they changed their beneficiary designations, and it doesn't coordinate with their estate plan. In addition to, when reviewing these estate plans, Amy, making sure that the right beneficiaries are listed in the estate, and through the plan, along with who are the trustees, right? Who are the fiduciaries that you picked? Maybe they're a family member, a friend, a corporate trustee, et cetera, making sure that that still meets your needs, the wishes that you have, and the future for that trust and for your family.
Yeah, the trustees review, that is a big thing, because I have seen a lot of trust documents where the trustee is no longer alive. And
Yep.
Who is the successor trustee? Oh, there's no named successor trustee. So now we have to figure out how you're going to appoint a successor trustee. Who is that going to be? So really reviewing the trustees and making sure that makes sense. And sometimes that's an opportunity to decant the trust in order to create new trustees and new provisions related to that, and introduce a trust protector. That can be really powerful. So we can help with all of this. We can certainly help in reviews of estate plans and looking at everything that you have in place, and really coming up with recommendations on changes that might make sense, both from an investment perspective on the HBKS side, as well as an income tax planning and estate tax planning perspective on the HBK side. And I work very closely with attorneys on a regular basis to talk through the different plans, talk through what changes can be made. So we can absolutely help. We encourage everyone to reach out to their HBK tax advisor or their HBKS advisor, and really kind of start that process there. But something I want to talk about a little bit here as we're waiting for questions to come in, we have a legislative impact assessment that we are doing on the HBK side, where we are really looking at the different provisions that came out of this One Big Beautiful Bill, or OB3. And we're really looking at some of the potential opportunities that our individuals and our businesses have with all of the different changes. Now, there's not extreme changes on the individual side, but permanency can be a really big piece of planning. And certainly the different things that we've talked about today are things that we would look at as part of this strategic assessment. So I encourage anyone, if you are interested in having a legislative impact assessment, to please reach out. Look for an email that will give you guidance on how you can sign up to learn more information about that. And with that, I think we have some questions that we can answer here. So Michelle or Wayne, somebody going to read off the questions here?
Yes, we did get a couple of questions that came in. The first one is, what if you already did a slat? What are the options? Can you decant a slat from Florida?
Yeah, so Florida does have a decanting law, and we see decanting happen a lot with slats specifically. I've had some clients where we've had to decant a few times just to correct certain provisions. And sometimes that happens just in looking at the different attorneys, and maybe they missed something there. So decanting can certainly happen in order to fix certain provisions that you might need, as well as add in some additional provisions that you might need in there as well.
The next question is, with that as well, can a slat use the annual gift exclusion back to the grantor or grantor spouse?
So the way that a slat works is it is established by a grantor for the benefit of the spouse, essentially. So you are making a trust for the benefit of your spouse, and your spouse typically will have that crummy power of withdrawal in there. And so that spouse then could withdraw a certain amount that's typically defined within the trust document, but generally no more than the $19,000, because that's the annual exclusion amount. It will refer to that annual exclusion. You cannot add in a power of withdrawal for the grantor, because then that's going to defeat the whole gifting purpose of an irrevocable trust and cause a portion of that trust to potentially be brought back into the grantor's estate.
Okay, the next question, yeah, does HBKS provide legal services for wills and trusts? Does it make sense to transfer our will to HBKS to keep the estate planning and trust management under the same management team?
Yeah, so a couple different ways to answer that question. So first off, we don't draft documents, so we don't provide legal services from the perspective of drafting your estate plan. We review your estate plan and help coordinate that with a qualified attorney. Both HBK and HBKS, we provide those services. And really, I think the numbers that I hear, it's really our involvement in that process to make sure that the estate plan is also implemented in a manner with which meets your needs and what you drafted. I think the number is like 60% of all estate plans don't get properly implemented. because the beneficiary designations and things that we mentioned earlier. However, we do work with a multiple number of fiduciaries. So if you need a trustee, like a corporate trustee or an executor for your estate, we can also coordinate those legal services if they're needed for your estate plan. And then, we retain and are the investment manager on those assets for our clients.
The next question is there a scenario that a spousal trust makes sense from a tax planning perspective if we are nowhere close to the married couple exemption from the OBBBA?
Yeah, so that's a really good question. Trusts themselves can have a place in an estate plan, even if you're not planning for the estate tax. And one of the main reasons that I see trusts put in place are for asset protection. It could be asset protection of the grantor or the spouse, or it could also be for future asset protection of the children, actually establishing an irrevocable trust right now that those assets are protected. And when the children eventually get married, if they potentially get divorced later on, or if they have substance abuse issues, that trust can potentially limit distributions out to the children and protect them so that those assets are not going to be lost. So there are a lot of different benefits that you can have from a trust, but it really just depends on your own specific circumstances as to whether it would make sense for you yourself.
The next question is, when our total assets are less than $8 million, do we need trust or will is fine?
I think that really just depends when you say, Paul.
Yeah, I mean, it's the fantastic answer of it really depends. There's certainly, once again, many uses for trusts. There's revocable trusts, which can help, avoid probate, which is, the court process to settle your estate, your will, whatever assets go through your will. So many of our clients will establish a revocable trust, which also can establish, if you become incapacitated, someone can step into your shoes as trustee and manage those assets and pay bills, et cetera, for you. So, a revocable trust could be used to ease the settlement of your estate and management of your estate. And then irrev trusts, once again, can, serve many different purposes, outside of, the exemption amount and retaining that. Sometimes beneficiaries need professional investment management. That can be supplied obviously through the trust or professional trustees, whether that is protection from an asset protection perspective for them if they're a surgeon or if they're in a highly litigious career, or even spousal divorces. So there's many different reasons that trust can be formed, whether that's for yourself or for someone else.
And the last question that came in is, if I want to establish a SLAT which owns an S Corp, do I also need to file a gift tax return?
That's a great question. And I have seen a lot of clients get confused about this because it's a trust for the benefit of their spouse and they're creating this trust, they're transferring assets in it. Well, what about the marital deduction? Well, remember, a spousal lifetime access trust, the whole point of that trust is that we're not claiming the marital deduction. So you do have a gift tax filing requirement. You might not owe any gift tax. You probably won't owe any gift tax, but the gift tax filing allows you to track how much exemption you have remaining after you've actually reported all the gifts to that trust. And it also allows you to track your generation skipping transfer tax exemption, which is a completely separate exemption from your estate tax. And quite frankly, a lot of generation skipping transfer tax plans can be incredibly, incredibly useful in the future. Because if you have a trust that is GST exempt and those assets continue to grow over the generations, minimal distributions are made, you could have a trust that is really, really large and beneficial for your grandchildren, for your great-grandchildren, and for future generations. So having a trust like that, it helps to build that generational wealth that you hear a lot of people talking about.
We could do a whole presentation on generation skipping transfer taxes.
We absolutely could. It's a very technical area and is often misunderstood and missed. I find that a lot.
We find a lot of flaws right? We find a lot of issues with trusts that do create generation trust and don't take advantage of some flexibility around that, right? So.
Yes, exactly. And sometimes you're required to go back and analyze, is it GST exempt? Is it not? What does that mean? Is there additional tax owed? We have seen some surprise tax situations come up there. So it's really important to take a look at that as well.
Yeah, I mean, it could be a big bust for a trust, right?
Yes.
To be taxable from generation to generation. So very important.
Yes. So with that, if that's all of the questions that we have, I think we can close out. Michelle, are you doing the closing here?
Yes, I want to thank you for everyone attending this session, and I really want to appreciate Paul and Amy for going over all this amazing information. Everyone will get a copy of the recording tomorrow via email, and I want to have everyone have a great rest of your day.